Welcome to the Flight Club Podcast, a woman's guide to leaning out. We give you a behind-the-scenes look at business launch and growth through the stories of successful female entrepreneurs. Here's your host, Felina Hansen, founder and CEO of Hera Hub.
Hello and welcome. I am really looking forward to my conversation today with Alisha Griffey. She, for the past decade, has served as a COO and CFO of 3 startups in the clean energy and healthcare industries. She's helped grow these companies from inception through exits that have ranged from small private sale to, of course, an IPO. In 2019, Alisha moved to the investor side of the table, where she founded Daintree Capital, an investment firm that provides working capital loans to underrepresented founders. And Daintree's portfolio now includes 12 companies across a broad range of industries. Alisha has her BA in economics from the University of Virginia and an MBA from Stanford University. She lives on the East Coast in Chevy Chase, Maryland, with her husband and 2 kids, and spends her weekends as a professional youth sports spectator. I love that. Welcome to the show today, Alisha.
Thanks so much for having me. I'm delighted to be here.
Wonderful. Well, let's dive in. I'm super excited to share your story. Start us off. Are you originally from the East Coast? Is that where you grew up? And then kind of take us through some of those early decisions in education and career path.
Sure. So yes, I grew up just outside of Washington, D.C., which I know is a bit odd. You know, most people in Washington kind of come and go. It's a bit of a transient city, but I was born and bred here, the child of 2 Peace Corps volunteers who somehow ended up giving birth to 3 MBAs. So I don't know exactly how that happened. Early on in my career, knew I wanted to be in the business world, but wasn't exactly sure what that would look like. There's so many different, versions of what a career in business looks like. I spent the early part of my career in strategy consulting because I found the issues really interesting and the people really smart. And I learned a ton early on in my career. Went to business school. And then after business school, was really excited to jump into the startup scene. I just love rolling up my sleeves and digging in to help companies solve practical problems about how to get things up and running and how to grow. And so spent a decade doing that, always in either a COO or CFO type role. And as you mentioned, mostly in the clean energy space, although I did have one 5-year stint in the healthcare space. So that world, that startup world, just was a really good fit for me. I love the practical nature of trying to make small companies work and trying to carve a new path into an industry that you're in. So I just really, really enjoyed that, but found myself frustrated by the lack of diversity there. So as you mentioned, I moved to the investor side of the table a year ago because I was really excited to try and figure out how I could be part of the solution in terms of getting more capital in the hands of underrepresented founders.
Wonderful. Well, I want to go back a little bit here along your path before we get to what you're up to now. Talk about that clean energy space. I mean, you were in that industry segment pretty early on. What did you see and what did you really enjoy about that segment?
Yeah, it's interesting. I love the clean energy space because I'm an environmentalist at heart, but I'm one who never understood a super pure view of the world where you couldn't buy products at all, or you had to have a view of the business world that embraced the idea that all corporations were bad. And so when I started in my late 20s, maybe started to do some more reading about this idea of building sustainable businesses and businesses that were founded on the idea of reducing greenhouse gas emissions and helping others to do the same, I got excited because I got excited at the idea that helping to build and grow these clean energy companies meant by definition that you were helping to solve the climate change problem. And so I was just very motivated by that, and did a couple different things in that space. Early on, the company, the very first startup I worked for was actually in the carbon credit space, which was back when, we thought there was a chance we might have cap and trade legislation in the US. And so it was a whole company built around the idea of helping to reduce emissions and giving people credit for those reductions. From that, I learned that the regulatory environment can change on a dime. And in this case, the regulatory environment did not go the way we were hoping it would, in terms of building a cap and trade system. And so, that company did some really cool things, but ultimately the regulatory space didn't support what we were building. And then I also was on the hardware side of things in clean energy, working for a fuel cell company, which, I think there's just some really, really interesting technologies out there that help us get closer and closer to having cleaner sources of energy, which is critical to solving the climate change problem.
Absolutely. Talk about, now that you're on the other side of the table, talk about some of the experiences you had, in raising money and being on that other side of the table.
Yeah, so as an operator, I did everything from helping to, put together small friends and family rounds, to, much larger Series A rounds, series, $100 million Series B round. I think we did at one point, and like you said, an IPO. So I've seen that real, gamut of scraping together every tiny dollar you can manage to find to build a company that is going to be super, super, super careful with how every single dollar is spent, all the way to companies that are really, really well funded from the get-go, because in our case, we had strategics that were behind those companies from day one. And so I saw the full range of what happens, both the good and the bad of having a lot of money at your fingertips. But one of the things I always found consistent, unfortunately, was the fact that I was almost always the only woman in the room on the management team side of the table, trying to put together the pitch, trying to make the pitch, close the deal, et cetera. And I was almost always the only woman in the room, even when you counted the investors. Not once did I ever have a woman on the other side of the table signing a personal check or signing a check on the behalf of a venture capital fund or a private equity fund. And so I found that really disconcerting. And so seeing those firsthand, seeing those examples in terms of the lack of diversity, the lack of gender diversity, lack of diversity in any way you want to define it, in terms of who is making the decisions about how money is allocated and what companies are being bet on, really was, unnerving. And I both saw it as a problem to solve, and I also saw it as an opportunity for investors who, like me, think that there are a bunch of founders out there who have great ideas, who have a lot of grit, who are tenacious, but don't have sufficient access to capital.
Absolutely. I'm sure you saw a lot, and obviously that's influencing your current venture.
For sure.
Yeah, absolutely. I want to talk a little bit about a couple, I know you're involved in a number of things, including Portfolio, CEO Activator, Enricher. Talk about some of these networks that you've been involved with and how that's informed your work at Daintree, or maybe not.
Yeah. So, good question. One of the things I've really enjoyed the most about being on the investor side of the table and focusing very explicitly on getting more investment capital to underrepresented founders is I have had the pleasure of not only meeting a bunch of really, really cool founders who are doing interesting things, and I always enjoy talking to them, but I've also met a bunch of fellow investors who are running against trying to solve this very same problem. And the problem is really, really big. As you know, I'm sure you and your listeners know, there's a lot of depressing statistics out there, like the fact that 97% of venture capital dollars flow to male-led companies. And when you see a statistic like that, you know that we have a lot of work to do to change the way capital flows in the investment space. And so there are a lot of people attacking this problem, and that is very exciting to me. But they're all doing it from different angles. And that's also exciting to me because I do think there's room for a lot of different approaches, and we need to attack the problem from lots of angles when it's as big as it is. So some of these organizations, SheEO I met early on, Vicki Saunders is a really interesting woman and a real innovator in this space. And I was drawn to what SheEO was doing because they're using debt as well as their investment tool. And I was intrigued by what they were doing. And I've ended up meeting a lot of really interesting founders through that SheEO network and have done several loans to SheEO companies as a result of those relationships. And then Portfolio has been really great too. They've pre-COVID, of course, had a lot of conferences and in-person events where I was just impressed with the caliber of the other people in the room and really motivated by working with some of these other women to attack this problem. So I found both of those networks to be very valuable to me, particularly as a new investor where building a deal pipeline is critical part of where I need to be spending my time.
Yeah, so let's dive into this conversation on, what you're doing and the idea of, and I believe Enrich Her is on this side of the table, the debt side versus the equity side, and decisions around that as you built Daintree, and really get into how you assess companies, what you're looking for, all of that.
Sure. So, becoming an investor is certainly not a very innovative idea by any stretch of the imagination. And it would have been very easy for me to just become another angel investor. And that's a great thing to do. But I came into my decision to become an investor with a very specific view based on my own experience on the operator side of the table. And my view really related to what was broken in our current system. And I really wanted to invest in a way that looked different from what everyone else was doing, because I think that's an important part of changing the dynamic and solving the problem. And so a couple of things that I saw, that were going wrong. Obviously, we already mentioned the fact that, women and even more specifically, women of color are just getting a minuscule portion of the investment pie, if you will. So that's kind of an obvious problem. A lot of people are attacking it, and there's lots of ways to do that. Everything from angel investing to things like becoming an LP with an organization like Portfolio, et cetera. The second big problem that I saw was that there were a lot of great companies, regardless of who's leading them, whether it's a man or a woman, a person of color or not, but there were a lot of great companies that were overlooked by equity investors because they weren't chasing hyper growth. For whatever reason, they were approaching growth from a more slow and steady focus on profitability and getting to profitability and sustainability versus chasing the kind of growth numbers that attract equity investors. And I kept seeing great companies that had these core fundamentals in terms of the way the economics of their business worked that were really appealing, but they were growing at 30% a year, 40% a year, 50% a year. And they were profitable or very close to profitable, but those numbers just weren't compelling enough to entice an equity investor to, believe a 10x investment bet, which is what they need in order to get behind an equity investment. And so those kinds of companies were intriguing to me because I loved the core economics and was frustrated by the fact that I wasn't seeing money flowing there. And then the last piece of it was that a lot of companies, if you look at the demographics in terms of where you lose diversity in the founder ranks. It's when it's between kind of the founding of the company and getting to that $1 million revenue number. There are women found companies at the same rate as men, but they don't get over the $1 million revenue threshold nearly as frequently as men. And so I wanted to focus on that part of the market. So if you add all those things together, focusing on underrepresented founders, focusing on companies that have strong core economics, but maybe have growth rates that are less than quote unquote hyper growth. It's more the zebras than the unicorns, if you will. And then lastly, focusing on companies that have strong revenue traction, but aren't over that $1 million revenue mark. So that became the part of the market I wanted to focus in on. And I viewed working capital loans as the best way to help those companies get over that $1 million revenue hurdle. So that's exactly what I am doing with Daintree, working capital loans for companies in the $100,000 to $1 million revenue range.
Awesome. And talk about, just so our listeners can kind of frame this, why would a firm reach out to Daintree versus a bank, for example? Yeah. Is it maybe they're not quite bankable yet, or what is that?
Sure. So it depends. But, there are a lot of traditional bank loans out there that are fantastic if you already have a business that is far enough along that you've got either a bunch of collateral or you have enough cash in the bank already to serve as a backstop for that loan. So those kinds of situations, bank loans make a ton of sense for businesses that already have that level of traction. There's also an opportunity to do more traditional bank loans for earlier entrepreneurs who are willing to use their personal assets as collateral. So, imagine taking out a home equity loan, you pull out a bunch of cash from your house and you use that to start your business. So those are two ways you can approach it, but there's a bunch of problems with that, right? If your goal is trying to help underrepresented founders, there's a lot of underrepresented founders who maybe don't have a house that they can put up as collateral for their loan. Or maybe they do, but they're not comfortable commingling the financial situation of their company with their own, personal finances. So those early stage companies where the founder isn't willing to have their entire personal financial situation tied to the company is a place where traditional bank loans just don't then apply. So instead, what I do is I talk to those companies and I do loans that are usually in the $10,000 to $30,000 range. They are not secured, so I do not ask for collateral. I don't want to own anyone's 20-year-old Honda Accord, and nor do I want to be in the business of taking collateral from someone if they were to default. So what I do instead then is my interest rates are a little bit higher than what you would find if you had a home equity loan, because obviously you've got tremendous collateral in that situation. And I'm taking a high risk bet on an early stage company. But my loans are much, much lower than credit card debt. So I tend to live in that 10 to 15% annual interest rate range, where I'm well below credit card debt, but I'm higher than, say, a home equity loan type alternative. And those kinds of loans I'm finding are really appealing to companies that have great traction with their customers and have revenue kind of coming in the door and growing, but maybe can't afford to make that next inventory purchase be any bigger than their last inventory purchase, which of course is always a growth constraint. Then if inventory is flying off the shelves and yet you can't increase your purchases each time because the revenue lags the inventory purchase, then your growth is constrained. So I've ended up doing a lot of inventory financing, not by design, but because that's where there was need. So that's what I end up doing oftentimes with product companies, and with service companies, it tends to be more things like maybe forward hiring against a contract they just signed with a customer, or maybe it's geographic expansion, or maybe it's equipment purchase that they need in order to move forward with whatever expanding their service business in some way. So those are the kinds of loans that I focus on.
Great. And then just by way of, definition here, talk a bit about some of the loans you're doing might kind of parallel, say, a factoring type of situation. If, somebody's got a PO and they just need to bring in, manufacture a product for that. What would be kind of the differences if you're willing to talk about factoring, just again, by way of definition?
Sure. So, the good news is there are many more options in, the early stage business lending space. Factoring is one. There's a lot now, whether it's, through PayPal or through Stripe or through a bunch of these different e-commerce backbone businesses where you can do more revenue-based lending as well. Most of those require, though, a volume and a financial history that is longer than what than where I'm focusing. So I'm still focusing on pretty darn early stage companies that maybe don't quite have as enough of a track record as is required by some of those other traditional sources of capital. The companies I work with, they have to be in business for at least 1 year, but often they're in business for not much more than that. And they do have to have over 100,000 in revenue, so I can see some of that traction. But what I do, and instead of relying on years and years of financial data to underwrite this loan, what I do is I look back over the past 6 to not 12 months at their revenue history. And I try and understand how much they have available in terms of monthly cash flow. And I do a pretty straightforward analysis on what would the monthly payment look like for one of my loans, and how confident am I that their business is kicking off enough cash to be able to make those monthly loan repayments. But I'm doing it more on kind of a shorter term analysis basis than a lot of other bigger lenders are willing to do.
Great. Give us a story, Alisha, maybe one of, a recent investment, or one of, I don't want to say favorite, but something, an investment you found very interesting.
Sure. Well, I'll give you an example of one of the companies I did a loan for at the end of last year. It's a company called Lilu, Lilu. And the woman who founded that company, her background is actually in technology. And she's a young woman who herself is not yet a mom, but who had understood in the market, talking to other people about a lot of problems that existed in terms of breastfeeding and women wanting to breastfeed, but struggling to do so. And her background was in technology. And so she basically put her experience together from a technology perspective, then working with some textile manufacturers, and came up with a bra, a nursing bra that actually is designed to be used while you're pumping and helps increase the flow of milk and increase milk production when you're pumping. And it increases your milk production by about 30%, which for anyone who has had a kid, 30% increase, we all know, is a lot when it's, drops of gold that you're talking about in terms of breast milk. And so this is the product that she created, and she put it out there. And it was hugely popular and very successful, and a lot of people loved it. But the problem she had was, because of her capital constraints, she was only able to do production runs of 2 sizes. So she had small size and she had medium size, and that was it. And everyone who fit in those sizes loved it. But her number one request from her customers was, I need a different size. I need a large. I need an extra large. I need an extra small. Whatever it is, that she had these requests for different sizes. And while her bra was selling off the shelves and people were placing these orders, and on a per unit basis, every bra she sold was profitable, she wasn't generating enough cash in order to place this really big order she needed to place to hit the production minimums to do a size large and a size extra large. Mm-hmm. And so I looked at what she was doing. She had been in business for just about a year. She only had about 6 months worth of sales, but I looked at it, and what I saw was tremendous traction, great feedback from customers, unit economics that were really appealing. But she needed needed about $20,000 in order to place a much larger inventory run than she could afford. And so I did a loan for her of that amount, and it allowed her to pull forward the offering of these larger sizes of her product by about 4 months versus what she was going to be able to do if she had to fund that inventory from her own cash flows.
Love it. Great example. Well, if our listeners want to learn more about you, want to get in touch with you, want to learn more about Daintree Capital, Alisha, what is the best way for them to do that?
Sure. It's easiest way is through our website. So it is Daintree, Daintree, cap.com, cap being short for capital. So DaintreeCap.com. And there's more information on the website. There's a way to reach me directly. You can apply for a loan from the website, et cetera. And it's just gives you a good overview of what our criteria is, and also tells some stories of some of the companies that we've funded. I'm always eager to talk to founders. So hope some of your listeners might be interested, and I would love to chat with them.
Wonderful. Thank you so much for your time, Alisha. I've really enjoyed our conversation.
I enjoyed it as well. Thank you so much, and appreciate all you're doing to help build community within the founder space as well.
Thank you for joining this week's episode of Flight Club, sponsored by Hera Hub. We look forward to sharing more success stories with you soon.